Welcome everyone to session 5. I know some people are relatively new, but make sure you watch the recordings because this is not going to make much sense if you don't watch the recordings and know the base understanding. We'll do some similar things. I want to cover price action from the last 3 days or so, and in that we'll go over the setups, what you should have taken, what you shouldn't have taken, why you should have taken them, and so forth. So you can kind of get that repetition of identifying trades, knowing when to get out, knowing when to get in, and just reaffirming that, because I've seen a lot of people in the chats post stuff that is good, but it's not necessarily like the best way to do things. So I want to reaffirm that principle. So we'll go over the price. We'll talk about order blocks because an order block is another foundational aspect to trading smart money based. I use them, but I've found the fair value gaps to be more accurate in terms of where price ends up. But typically order blocks are close to where the fair value gaps are. So we'll do some of that. And then I have a couple other small things that we'll introduce as well. So if you have any questions, feel free to put it in the chat. And I will periodically look through that. Only 13 people. Wow. Must be a long Wednesday. Well, I guess it's easy to watch the recordings, but so let's look. There's an important concept that of liquidity, and I know I keep saying it because it's the most important concept in a market. When you think about liquidity in a comparison, like a car needs gas to drive, but a market needs liquidity to move. So that's why you see people talk about volume, which in a sense, volume is an indication of how much liquidity there is, but it's also a bad indication of price because price can move up and down on low volume, chop on high volume. I mean, but it is an indication of how much liquidity is in the market. So what you need to understand is there's multiple time frames of what liquidity refers to. So for example, daily time frame, let's draw our boxes. First, boxes, there's 3 little areas of liquidity. So this is where the daily liquidity is going to be. Forget this price action happened. This is the support. Retail is going to be buying long here. And so on the daily time frame, here is your major liquidity, right? Now, most of y'all probably saw these 3 big red candles. And the Fed meeting today happens right around here in this liquidity zone. And it's no circumstance or no happenstance that's the way it happened, because here is where most of the put side liquidity is, sell side liquidity, that the market makers want. And people that are in the markets in general that are not necessarily making the markets, they want this liquidity. This is especially on a daily time frame, this is where you can see some aggressive price movements. So that's the first concept, is on the daily time frame, you want to make sure you mark out the large areas of liquidity. But this also means when you zoom in to a smaller time frame, that you also have to consider where the larger term liquidity is. So all of this price action right here is essentially in long-term buying liquidity, right? Now, what happened the other day was I took this trade, and I think I alerted that this was going to happen. What did we talk about last time? Essentially a double bottom, right? Essentially a double bottom. And then you have more liquidity right here. And then you have a fair value gap that was created because of this. So this is a liquidity sweep right here. And I know a lot of people ask me, what makes it a liquidity sweep? And we've talked about this as well, but it's not a liquidity sweep until something happens. Like if price dropped below here and just continued, then there's nothing. I mean, it's just normal price movement. But because we have this large displacement above the previous liquidity zone, so here below this structure right here is the liquidity. If we see displacement above that liquidity back against like where price is going, then that's a strong indication of what's going to happen. Now, This is a long-term liquidity sweep as well as a short-term, just because of the time frame. So we're in the daily time frame, and then now we're on the 5-minute time frame. You have a fair value gap that's triggered based off of this. And so this is a pretty confident play, in my opinion. In my book, this is a very confident play because you essentially have a double bottom here. And if you're a retail trader, double bottoms mean what? Buys. So you're buying in this area, and then you're probably putting your stop loss down here. So they're looking for liquidity sweeps. They're looking for those stops to be taken, and they're displacing price in the opposing direction. And then, as you can see, we have some nice trending upward price based off of that. So we talked about last time, double bottoms are notoriously known for this, and this, generally speaking, means a trend reversal, at least on the time frame you're talking about. So 5-minute, 15-minute. So we have a nice, from the bottom here, 11.25 to 11.7, or I guess higher, 11.75.8. But the principle is here that this is what I'm looking for: displacement above the previous structure that created that liquidity, which would be here. Okay. And then once you see that, that's a pretty telling sign. Let's do another example of multiple time frame liquidity. So for example, here, 4-hour time frame. This is a swing high. So we see some selling pressure, and then we see some buying. Where is the major liquidity going to be? Right around here. Now, this is a 4-hour time frame, so we know that's a larger term, like a larger move of liquidity, but we're making decisions based on the shorter time frame. So we want to go here and look. Now, there's no rhyme or reason to draw the size of this liquidity zone. I mean, it's based on the time frame, right? So if you're trading on a 1-minute time frame, you're going to have like this. I don't know, daily is going to be a little larger and so forth. But for the purposes of this, I'm just showing that this was a liquidity zone based on this, but it also forms the setup on a smaller time frame. I think it was the 15-minute on this one. Yeah, it was. Okay. 15-minute, we have pretty high price movement up here. Then the first time we do see a liquidity sweep and creating that fair value gap is actually right here. Now, you do have some chop. If you got in, and remember, where do we put our stop loss? It would be, you could put it here, or you could put it here, depending on your risk tolerance. Technically, this is where you should put it, but if you wanted to put it right here, so that's fine. So you do have some chop. Let's say you didn't get in there, even though you know this is a 4-hour liquidity zone and you just formed a fair value gap. You're respecting it so far. But then you have some true displacement, which is here. So you have that aggressive displacement. You have another fair value gap, but it doesn't retest. It doesn't even think about retesting. And in these situations where you have multiple time frame liquidity, it's less likely that you're going to see these retests like that, right? Very, I don't want to say very, but it's a lot less likely that you'll see these retests, especially when it's a larger time frame, and then you also have smaller time frame liquidities based displacements. So, yeah. So make sure you are aware of the larger time frame. So let's look to the future a little bit. Okay, let's look to the future. 4-hour time frame or so. Where is the major liquidity on the 4-hour time frame? You really only have some like down here, which would be the new lows. And then you have major 4-hour liquidity up here. So right now, there's not a lot of convincing plays based on larger term liquidity. So it's kind of a little bit of a no man's land. But as we talked about here, we had that liquidity sweep. So now we are in a, I would say this is a low that's formed, but it's also a lower low. But I still don't have necessarily confidence in determining my bias based off of this. So I would be more inclined to do smaller trades, like day trades. 25%, it's plugged in, it's going down. Where was I? Oh, yeah. So here is your 4-hour liquidity. Obviously, there's no lows here. This is just a huge displacement. So let's go back to one of our other previous concepts. It's here. So swing high, swing low. This is where you would start thinking about potentially selling if the setup forms roughly in this area from here, because we have a low formed until about here. I would not really consider shorting the market unless you have a intraday setup. But yeah. All righty. Let's go. Let's discuss some price action that happened. So what we want to do is we want to draw our lines at the 930 price. Okay. All right, so here's 930. I think. Yep, 930. So that's 930. And from looking at this chart, we don't have a lot to go off of. We have, I guess we have a little bit of liquidity here. We have, I guess, your most recent swing low. That's the actual low would be here. Don't have a lot to go off of here. So let's see what happens when price opens up on a smaller time frame. Because ultimately you're going to be making your entry and exit decisions based off of that time frame. So here's the 1 minute. If you're trading on a 1 minute time frame, you are a scalper. You should not be making long-term decisions based off of a 1 minute time frame. So as you can see, most oftentimes at the open, we like to take liquidity on both sides. But remember, this is a 1 minute time frame, so we took a little bit there. We took some here. So it's just a chop fest at open here. Boom, took that, boom, took that. And then now we kind of create a little bit of price movement. But remember, nothing has happened for me yet. The first setup that happens on the 1 minute time frame is right here. Liquidity above here, because we have a swing high that is formed. We have fair value gap, displacement. Remember, this is a 1 minute time frame. You can't expect much. And then we have you would put where? You would put your stop loss. And just so happens to have a pretty nice movement from 526, bottoms out at 434. Now, people ask me, where do I exit? What do I get out of? Well, the first thing you want to look for is where is your next liquidity zone? And that happens to be right around here. So from 525 to 458, that is a excellent 1 minute trade, 1 minute time frame trade. All right. So let's look for the next potential setup. We have, one thing I think people are struggling with is it's much more probable to be taking fair value gaps that are against the existing trend. And when I say that, this is an example. So we're in a downtrend on the 1 minute time frame. Now you see this, you see a doji here just below this little liquidity zone. I know people think, why don't I sell short here? Well, that just doesn't make a whole lot of sense because it's not liquidity based. You're just going with the trend and hoping. This is a hopeful situation that this is a continuation of the downtrend, but there's no reason or no indication that it is. Now you might say, well, Matt, it would have worked right here. Yeah, sure. It would have worked right there for a little bit, but what are we looking for? We're looking for higher probability decisions that we can make on a regular ongoing basis and be right about it. So get rid of that. Get rid of that. So nothing here. There's no fair value gaps. Nothing was created. First time. So this is the little mini one here. What do we have? We have a little double bottom on these 2 wicks. Remember, this is a 1 minute time frame. And you can I do condone trading on the 1 minute time frame because On NAS, there's so much liquidity and there's so much price movement that the price is accurate on the chart. So we have a little double bottom, we have liquidity sweep, we have displacement, and we have a fair value gap, which forms right here. Now price kind of consolidates here, and this is where you think to yourself, well, I'm not confident. I don't want to stay in this trade. Well, you don't have to be confident. I mean, you do, but it doesn't matter because where do you put your stop? Right around there. Okay. And then we have a aggressive uptrend movement. Now, where would you get out of this trade? Well, technically here, if you have proper risk management, 462 to around 490, it's a 30-point move. But as you can see, it continued on the trend based on the setup. Alrighty, let's look for the next one. Nothing. And so another something you can look for is when you're in a trade like this, and let's say you took 80% of your profit here and you're just leaving 20% runners. The first thing you want to look for is where the setup is formed in the opposing direction, because you want to be out of the trade. You want to be out as far, you want to be like, go step away from the computer. So we have from 461, price tops out at 535, so forth. Looks like a little double top. And then we have a fair value gap that's created here. Now, this is the start of the downtrend, and this is where you want to be out of the trade. Okay. Let's look for the next one, because this is technically not a liquidity-based fair value gap, but it does look like a pretty decent option. Alrighty. Let's go down to the next one. Remember, don't take the ones that are with the trend if there's no liquidity. Because here, like somebody, I think, probably would have been like, well, why wouldn't you take that? Because it's not against the trend. So instead, what do? We look for this one. Now, you can, as you start to think a little bit more about this stuff, you'll understand that this is probably not a gap on the 1 minute time frame, but on the 3 minute, this is probably a gap that forms right around here. So you can switch back and forth all you want. I do quite often, but this is in another setup. You have the liquidity from here. You have displacement, retest, fair value gap, and then you have so forth. Alrighty, I mean, this happens every day. So I can go over this. If I wanted to, I could spend 10 hours doing this for the last 40 days. And but the setup is there every single day. So let's cover. Oh, that was the 9:30. Oh, that was just one day. See, this was just today. That's crazy. All right. So now I want to go over the trade that I took today. So I actually took a trade off of the 30-second time frame that made the profits for today. So typically what happens, so 1 o'clock we had the Fed meeting, 1 o'clock or 2 o'clock Eastern. What they're going to do is they are going to try and just destroy the market liquidity. They want it all. They want both sides. So what you do is you typically see aggressive movements in both directions before the real trend change. So what I did is I waited for the news to hit, which was pretty bearish, but not super bearish. Like, it wasn't terrible, but it didn't matter to me. I don't care about that. So price pops up. As you can see here, this is a huge liquidity take. You have huge displacement, retest, and then you have a sell-off. So I know some people, I think there was one person who took this that DM'd me, but this is not a bad option. Just know that you have to get out of a trade, and it's higher risk because of the situation. So then we have the liquidity taken on the downside. and then we have a retest. And so what I was looking for is I'm looking for the newly formed liquidity, which was here and here. Now, typically what happens when the Fed speaks is you want to reverse the trend of the current market. It's just, that's just how it is, because the retail is thinking bearish, the whole world is thinking bearish, and that's usually what happens. So I already have the mindset that I'm looking for buys. I think I said that this morning, but I just had a bad gut feeling. But forget your gut feeling. Just go with the chart. So typically what happens is we have a sell-off or a buy, and then the Fed decision or Fed meeting changes the structure of the market. So I already had that in my thought process. And I know there's a lot of money to be made in the volatility of the Fed speaking. So I took, as soon as I saw this dip below, now there wasn't necessarily a fair value gap that formed, but I saw this displacement above the previous structure, and I knew that I could take a pretty substantial risk here. Just do the same thing I always do. Stops here and take profit where? Here. Now it doesn't look like a lot, but this is a 367 to 540. Like, that's a huge move. You could size down and still make easy 200% on these big moves, just because of how the market is and the Fed volatility. Now, same thing happens, come up here. There wasn't any, maybe it was a 1 minute. No. Well, this was a pretty aggressive liquidity sweep here. I think on the 3 minute, it'll probably show. Yeah. So as you can see, they just want as much. They're greedy. And then you have a nice sell-off into close. So when you see something like this, I don't even wait for the retest, because I don't care. Like, you got to know the market circumstances. Close to the end of the day, the end of the trading session, 30 minutes before, if we see aggressive displacement like this, I'm getting in. I don't care. And I'll put my stop loss up here. You have to know that the FOMC meetings are highly volatile, so make sure you do size down on your positions. But this is aggressive displacement above into a liquidity zone. So I'm confident that that's going to work out for me. All right. And then tomorrow, I'm guessing, I'm pretty sure, especially because futures are up 0.9%, I'm sure we see some more buying pressure, because shorts will be covering and we should see some buying. All right. So that, let's go to, let's see here. Oh, this will be a good transition. All right. So another reason why I knew this was the bottom is something, there's a lot of different names for it, but the NASDAQ, so the big three are the NASDAQ, US 30, SPX 500. I use these just because they have futures price movement, but they move similarly in terms of the setups that I play, right? And you want to be able to, even though I make and execute trades on the NASDAQ 100, I also look at the SPX and then less so the US 30. And the reason for that is I want to see, let's say, for example, there's the most beautiful setup ever created, just face ripper for retail. And on SPX, there's a super opposing setup, which can happen. Then according to my risk management, I don't want to get into that because they don't agree. Now, vice versa, they can also help you with your agreements. And I'll show you an example that happened today. So let's go over to, actually, I usually have another screen, but okay, here we go. All right, so let's look at the same time frame. 5 minute, 5 minute. So how did I know that price was going to stop here on NASDAQ? Well, I looked at the chart for the SPX 500. So as you can see, the fair value gap that was created from that major liquidity double bottom sweep for the NASDAQ is much lower. So this would have been a higher probability trade to take for NASDAQ. But if you go over in here and look at the SPX, S&P, spiders, whatever you want to call it, the fair value gap is actually much closer to the price action. So if you're a smart money enthusiast, this is called the smart money theory, is essentially using the indices to trade together. So if I'm looking at the SPX, I see a fair value gap that's created, and the NASDAQ is doing the same thing, but a little bit of a shorter time frame, taking out liquidity. Then I'm much more confident in taking the US 100 trade, so the NASDAQ trade, based off of the fact that price is forming the exact same setup over here on the S&Ps. Now, that might not make sense, but if consider this being the NASDAQ chart, I would have taken this trade 100 times over. Put your stop down here, especially during the FOMC. That's a huge risk reward potential. I mean, just absolutely massive. If you were taking buys here on Forex, you could still be in the trade and then just ride this baby up probably tomorrow or the next day. Let's check out US 30, see if there was anything in agreement. I don't think I used that. Actually, it worked out. I didn't look at it today, but same concept. Here's the gap. I think that's where it is. Put your stop here, theoretically. But I always execute on NASDAQ just because I know it better. I know the price movement. I know the contracts better. I know everything about it. It's just like part of my sounds down. Sorry. Oh shit. Sorry, I was looking at this. By size down, do you mean instead of doing your regular one lots? Yes. So let's say, for example, my normal position on a QQQ trade for a day trade is like $2,000. Then if I'm taking more risk in terms of if I'm trading during the FOMC, then I'll size down to 1,000 or 500, because you do have a lot more potential for the contracts to increase, but you also have a lot more potential to lose the money. But with options, I mean, you can only lose what you put in. So that's kind of my thought process, and it works fine. What happened at 11 a.m. happened at 11 a.m. Not sure what that was referenced to, but I apologize. I'll try to look at that more often. Chat, hold on one second. All right. So this is kind of the same process. Now let's do another example that might also help. Is let's assume that you are waiting for the NASDAQ to get here because that's the higher probability setup. Well, let's go back to SPX. You know that what is below here, there is liquidity, regardless if that's a fair value gap. You know there's liquidity down here. So let's say price dips below this and you see displacement that forms. Let's say you see displacement, but you're not sure. There's no fair value gap that's created because of this displacement. But over here on NASDAQ, your price is here. So now you have a SPX setup almost, but not 100%. But then you have a retest of this high probability liquidity based fair value gap. So now you're using this correlation to kind of help drive your mind towards making a more confident decision based off of the correlation between these two. Now, this works in a lot of different circumstances. So let's take this one, for example, gold and silver. I haven't looked at the chart much for correlation, but it's definitely there. So let's see. Let's go to a 15-minute. And look and see what happened. Alrighty, so not Not as much correlation here. There's no example that's jumping out to me at the current time. But here's another example actually. So let's say, for example, you're trading gold over here, and you see this price movement, and you know that here's a low or here's a high. Here is the liquidity above that. Now you come over here and you say silver. Silver is actually not above the liquidity zone. So this is kind of a smart money theory divergence where two things that are highly correlated are not necessarily behaving in a similar pattern. So if you see a gold liquidity sweep and you see silver that's not even above the liquidity area, then that's kind of telling you that there's going to be some selling or reversal. Now on the 15-minute over here, there's not necessarily a trade. Let's go down to the 3-minute. And we do have a little bit of a fair value gap. We have a little bit of a smaller time frame liquidity sweep, fair value gap, retest, selling. But the reason you could be more confident in this is because you come over here and you say, well, silver didn't even get above that resistance because there's a divergence in their price. You can have divergences in indicators where this is a divergence, but you can also have divergence in price movement between highly correlated pairs or indices or even crypto. Let's check out crypto for all the fiends out there. So let's do Bitcoin and Ethereum. 15, 15. All right. So these are actually move very similarly. So it's a little bit harder. But let's look, for example, at the most recent price movement. Well, I already know, I mean, this was just a gold mine for setups because look, you got a little bit of a double bottom type formation here. Now we know there's liquidity down here. Don't know how big it is. Don't care. So let's assume that I drew it perfectly and here's the liquidity zone. So we'll draw it back. So if I'm a retailer, oh God, I got to get in puts here. I'm screwed, or I'm going to buy calls here. But no, this is a massive liquidity sweep. You have a fair value gap that is created here. You have a retest, displacement, retest, and then up. You have another one here that's based off. I mean, you can do this all day, guys and gentlemen, ladies, whatever. Retest and then selling. But my point is, if they're forming, if you see two identical setups on correlating pairs, the likelihood that it succeeds is very high. Identical setups, correlating pairs. It's something that means it's more than just a single incident or a single area of interest for a particular coin or metal or anything, because there's a correlation between the two. Now let's go to something that's correlated but not identical, Litecoin. So here, for example, this was a much more, so as you can see, Litecoin relative to Bitcoin is much more bullish from that last movement that we had here, because it had what? It had a much larger fair value gap. It had the liquidity that was taken. Same thing here. Fair value gap created, displacement, but the retest here was a lot less aggressive because it didn't have to go down as much. So for example, let's see, at 415, what happens? It's at the exact midpoint, and this is almost exact, that both the coins are forming the exact same bullish setup, exact same. So there is correlation. There's a reason that coins move together. It's not because Jimmy at the trade desk is pressing buy at the same time on two keys. That's not how it works. But this is how you can help hone in on your setups, the probability, the confidence, the pretty much everything. Now let's do a currency pair example, which don't work as well because I'll show you why. see. So like here, for example, it's a lot harder. Well, they're pretty much non-existent because they're comparing two different things. So if I get a question that says, why is this concept not working on um, currency pairs, it's because you're comparing two completely different things, the dollar and the pound. They could be moving at highly differentiated price movements. All right, so that's basically the smart money theory is smart money theory. Alrighty, so let's go back to one chart. So now we're gonna do one more new topic, and then I will answer questions and we'll do some more analysis of stuff. But I'm gonna get some water real quick, so I'll be back. Oh yeah, feel free to type questions if you have them. I'll come back and answer some. All right. Alrighty, no questions. I must be a genius teacher. So let's discuss order block theory. And depending on who you ask, they'll teach it differently, depending on what kind of expertise they have or the reasoning. The reasoning behind it is kind of up for grabs in terms of what causes the order block theory to occur. But that's not really as important to me. I know so little, I do not know what to even ask. Yes, it works on higher time frames as well. Almost all the concepts I teach work on all time frames. It just depends on the market liquidity. So indices have a lot more liquidity in the market in terms of like movements. They don't like gap up really aggressively and skip candles like crypto does. But yeah, it's not a bad thing. After the next session, there won't be any huge new concepts. We'll be reconfirming a lot of the existing ones and going over setups and everything. So I think next session will be the last one with drastically new topics. So you should be good. All right. So order block theory is, I know everyone's heard of order blocks before or seen them or used them or whatnot. The way I think about order blocks is it's kind of a series of candles usually that create large movements in price for whatever reason. And it really comes down to order execution, or that just happens to be somebody or a series of people entering the markets. And it's kind of a period where before you see aggressive price movements. So for example, let's go to a highly aggressive one on the daily time frame. Oh, gotta go back to that. Alrighty. So for example, let's look at here. So let's look at, usually it's characterized by a series of 2 to 3 candles that kind of create a reversal or a large move in price action. So I would consider here a little bit of an order block. Here's an order block because they create those movements. So instead of thinking about it in terms of a fair value gap, which for me would be here, generally speaking, it's the price above that. So for instance, here where there's a fair value gap created that I like to play, the order block personnel or people will consider this an order block because it creates that displacement that we talk about in price. So this can be where a large amount of orders were accumulated and then they were distributed on the sell side at the same time or relatively on the same time. It could be a lack of buyers in the market. It could be it's mainly the main reason is because the algorithms are programmed that way to create these blocks of movement, and they kind of leave these little trail crumbs. So generally speaking, it's the price above the displacement that creates the fair value gap. So here you have the fair value gap, you have the displacement, here is that order block. So if you go down to the 4-hour time frame, you can kind of see it's usually characterized by a series of maybe 2 or 3 up candles, 2 or 3 down candles, and that kind of creates the order block. But depending on the looks of it, like here's a good example. I would consider this an order block because you have this series of remember this is a 4-hour time frame, a series of green candles, and then you have aggressive displacement, and that kind of characterizes the qualifications for an order block. And then that's what creates the retracement. So order blocks, the important thing about them is that price typically will respect them on a retest. So I like to think about more of once again, for value gaps, but I would consider this little top portion here an order block. So let's use a different, God, I hate TradingView when it comes to this stuff. I don't know why, maybe I'm just dumb. I'll use this. Nope, that was not the right one. Okay, I'm not wasting time, but we'll consider this an order block. So if you were to play the fair value gap methodology that I teach, you would have won same way. Retest, stop loss, and you would have had selling. But the order block people would use this as a reason to enter the trade based on the order block. Same thing here. You have a couple up candles, then you have aggressive displacement, retest, and then that creates more selling. So a couple different order blocks here. Same thing here. You have a couple, 2 green candles, so usually 1 or 2 depending, and then you have aggressive displacement, and that kind of creates the order block that's associated with it right here. Doesn't always have to be green candles. It could be consolidation like here, and then you have a displacement, consolidation, displacement, and then you would characterize, instead of looking at the fair value gaps, you would kind of say, here's the order block. I should be using a different color, but yeah, whatever. Order block. And then on the bull side, same concept. You have a couple candles here, aggressive buy, a couple candles here, aggressive buy. So that's kind of the order blocks. They are usually respected quite well. They are also something where price likes to retrace to. And the concept behind that is, so let's, for example, here. So a couple candles, aggressiveness. So this is also a liquidity-based fair value gap, but you have a order block here. So the order block traders would have waited until the FVGs were filled, and they would have gotten in at the order block here. Now, the reason why this happens is because there is an interest of, let's say, a large order or a series of orders came in at this point. The liquidity was here, and they decided to take it higher. Now there's probably some unfilled orders here, and there's also going to be interest in buying here as well on a retest. So it's just used as a second chance opportunity for most good traders, for example. Are we also discussing JEX? Yes, not today, I don't think, because that's I'm not sure if I want to go into too much detail with that because it will most likely require a separate subscription, and I don't really want to get into that. What the hell? Oh, I know what it is. Hold on, I'll be right back. All right. The consolidation does seem hard to tell which way it will go, and that's the point. You don't want to make it extremely easy for retailers to know. Like here, for example, I mean, sell off, you see 5, 6 straight green candles. I mean, most retailers would be like, well, this is just a fake out, let's buy. Well, they just wanted to retrace and get price back to the order block where the rest of the orders or the new orders could get filled. Same thing up here, really. I mean, this is basically just a order block hell. And then if you were me or one of my students, you would have taken this one. Boom. But I do think there is a lot of value in understanding order blocks and why they happen in terms of like price wants to retrace to them. You want to trade on the side of order blocks. So for example, like here, you have this big green candle, a couple selling or a couple consolidation or slightly green, and then you have a sell-off retrace, and then price wants to go back up here, but it had to take some liquidity first. So a liquidity base sell-off, another order block back to that. So price just kind of, it wants to retrace back to that that original order block to create more positions or more opportunity, right? Let's go to see if there's any on the weekly. I haven't looked. No, nothing really I can see on the weekly. And if you see, that's kind of like the same premise behind the tweezer bottoms or tweezer tops. I don't see if we see any. Like if you see a tweezer bottom or a tweezer top, like here's the three. I would consider this a pretty nice order block. But it was so far away from the old price action that it just kind of went through it and went for the liquidity below here. But usually the tweezer bottoms or tweezer tops that you see are just order blocks that are being retraced to or created on smaller time frames. But I don't see any here on the daily consolidation. So what I would do for order blocks is just identify them. Make sure you are not trading against them if price goes back to that original area, because it won't work out for you in the long run. And then maybe use it for additional confirmation. So like I know we've gone over this setup quite a few times, but you see this nice green, you see a couple of consolidation candles and displacement. Just know that if price gets back to here, this is double confirmation that you probably should consider taking this retest. Right? Now, I want to introduce this because I haven't really given examples, but this week and the remainder of the week, I will post some. Okay, good. I will post some order block stuff. So like, let's go back to the 5-minute time frame. Ignore this. This is a bad example. Or it's not even an example. It's just the Fed creates these such violent price movements. Let's go over here. Don't see much. Let's try the hourly. It'll be a little more clear because you can have bigger candles. Yeah, so we already talked about this one. So here's the order block. Before you see the big displacement, price retraces all the way to the order block, and so forth. Here, same thing, couple consolidation, huge displacement, and usually you don't see it retrace, right? Like on the next candle. But this is the 8 o'clock. This is probably news based. So that's a good example. So let's assume, so this is the hourly time frame. Let's assume at 8 a.m., probably CPI or something came out and price just drastically sold off. The whole market executed sells, the liquidity is just dropped. Now, if it dropped like this on such an aggressive candle, you should expect that a retracement is going to happen. Now, I wouldn't say it might not all the way happen to all the way to the top, but it's likely to happen at least some of the way. But you know that this is an order block because you had that huge sell-off. This is the hourly time frame. So assume it happened on the 1 minute time frame. I would go look, but it might mess up my chart. So 8 a.m. we'll do, so this is the candle. 8 a.m. dropped. Here's the, pretend this is the 1 minute candle. 8 a.m. dropped hard. And this was one executed sell order, a series of them. But now price wants to retrace to that order block to get the rest of them. So now you have something like that. Oh, I forgot the path thing. I'm so bad at this. That's why I have the indicators do it for me. Nope, not that one. There we go. So you have a huge sell-off, and then now assume this is like a smaller time frame. You have some consolidation, a little buying, a little selling, but you want to get back to that order block, right? That's why you see when you see big displacement like this, a lot of the time there is a retrace to that order block, and then you would likely see some more aggressive selling after that, because now people have had time to prepare their orders. If you're an actual like smart money trader, so maybe like a JPM or a Goldman, you're a high frequency trading firm, you're likely not going to have gotten in on this trade because you're not an idiot. This is a risky algorithmic based trade, but it's more likely for you to get in on the order block retest, which happens here. And this happens a lot when you're doing news driven stuff. So like CPI, like housing, really inflation data, really anything. So let's go to 8 a.m. and see if there's another one. Or at 9:32. Like if you have an aggressive movement, price movement in one direction and then a reversal, a lot of the times it's just an order block that's being retested so that orders can be filled. It's like here's another one. You would say, if you were, because of the information we've learned so far, is you would say this is just a fair value gap retest, which it essentially is, but it goes a little bit higher into this order block and creates the additional selling pressure that's needed to drive price down. A lot of these are news driven, so unexpected moves that happens. This is another 8 a.m. I'm sure it was a gold inflation or monetary policy or something that caused price movement to aggressively jump. But naturally, price will return to that order block before selling off. These orders being filled, no, retail buyers, sellers have not enough buying power to move the market. So most of it is just general buying and selling that creates the liquidity. But there are people that are non-retail that are making trades. So like there's a lot of high frequency trading firms out there. There's big banks have trading sectors or segments in their business, and then you have people with just a lot of money that are doing it. But for the most part, you put in an order, the algorithm is what controls where it's executed on their end. So that's kind of the premise, is if you have large movements and an algo is the one that made that happen because of movement, then price is likely going to retrace to that level before a continuation of the trend, or like this. Huge displacement, but not enough people got their orders filled. People want their money, so they want to go back up to that and then sell off. Alrighty. And this gets a little more advanced. You can go in more in depth about it, because I'll just kind of present this idea and I'll take questions. So if I'm retail and I have a bunch of sell positions, then there are opposing parties, aka market makers that have buy positions, because we talked about this. There's opposing parties to every position. Now, if I am a retailer and I had sells and my opposing party has buys, right? And I'm smart and I see this big sell off and I take profits. Well, now the market makers are open with a losing trade. They've got a buy position that they have to close and get out of, right? Because they're on the other side of the options market, the forex market, futures market, whatever it is. They have to get out of the opposing position, which usually creates that retrace if there's a big movement like this. So retail is closing their puts, closing their sells. Now there's a bunch of market makers that have buy positions and they got to get out of those somehow. So they either cover their shorts, which creates this, or they want price to go back to here before they can get out of their positions at a break even or a gain. So these little movements that are created, they happen for a reason, but there's a lot of intricacies that go on behind the scenes to create that. But just know that there's an opposing party. If you're winning, someone else is losing. If you're losing, someone else is winning. So when you think about price moving in one direction, there's going to be an opposing party that is losing, and they have to figure out most likely how to fix that, right? How can they fix that situation they're in? So, all right, there's 4 minutes left in the session. I will take questions now. Yeah, that is true. He never loses. This is a good time to ask questions if you want me to video explain something. Otherwise, I type in the chat. That's a good one. No questions? Go over the key concepts to look for. What do you mean? The whole course of the key concepts. How do you get so comfortable taking the opposite position in price action? Remember, Brian, what are retail traders conditioned to do? Trade with the trend. That's like step one of, so if I see a big red, and it's psychology behind it, because let's say, for example, I don't know if I mentioned this or not yet. Let's see, like for this example, I see 3 big red candles and I'm like, holy shit. Your brain tells you to sell. Like, it's just common. The red is bad. Red means I'm losing. Now I FOMO into a position probably down here, or I see some consolidation. I don't know. I FOMO into a position and I get short. What if everyone's getting short because the retail mindset is let's get short? Then why, if I'm a market maker, or if the liquidity is long, why would I want to go with the common perception of the market? It makes logical sense when you think about what is the perception of the market. So for example, what did I do? Like the whole bull trend of the bottom from March 2020 to, I guess, December or the end of 21, retail was just, I mean, you probably saw a bunch of profits and everything, but I mean, for the most part, retail was trying to find the top. Like they were trying to find the market crash because the economy was shit and the world was shut down. So if they see any sight of these red candles, just made everyone just lose it. And so the psychology is I'm looking for the setup that goes against that mentality. Against that mentality is what's going to make you successful, I promise. Now we've switched to a downtrend, and now the exact same thing is happening. Retail is getting way too bullish. They're buying the dip. You can look it up. There's metrics that show how much retail is buying. It's a record buying spree for retail traders. So every time you see these big green candles like here, big greens, people are buying. And what happens? Aggressive sell-off. Now, I agree. I was bullish. I had a bullish bias based on technicals alone, but I lost that bias right here, whereas most traders probably lost it down here. So now what happens again? Big reds, huge reds on the daily time frame. I come here, I go to the 15 minute, 5 minute, and I see my beautiful liquidity-based fair value gap right here at the bottom. And retail traders are so short, it's not even funny, because their mentality is telling them that. It's a psychology thing. I hope that answered your question. Brian, do I look at volatility? Not sure what you mean, like VIX? For me, VIX is irrelevant. It only determines contract pricing, and it does affect some behavior, but for the most part, it doesn't matter to me. Yeah, Brian, if you can switch your mindset to thinking like that, that you'll be much more successful. One thing I did actually when I used to teach a mentorship is I would teach people to change their candles to hollow or to normal, and I would get them to change the color scheme to one color, because it truly doesn't matter what the color of the candle is, but it changes your mentality, right? Like if I see a big red candle, like it's just my brain. It's just human nature to see this big red and be like, well, that sucks. I'm gonna get short. Well, this is an example of what it worked out for you, but for the most part, you want to make sure that you're not letting your mind trick you too much with the way candles are moving. And if you find yourself slipping up on that, zoom out. Go to the 4-hour time frame, zoom out, take a step back, rethink your decision, and make sure you're not fighting what we've taught in this class. You're in a liquidity zone consolidating, but you're in a liquidity zone consolidating. Your first mindset should be find the reversal, because retail saw this huge drop. They're shitting their pants. And this is where you should be looking for our setup that we've discussed, and you'll do fantastic. So hopefully that helped. I encourage all of you to rewatch the video, rewatch them all, do whatever it takes, find the setups, practice them. And if you have any questions, feel free to ask in the chat. Hopefully this helps. Still have 3 more sessions, so we will be continuing to build on our foundation. But appreciate it, guys. Have a great rest of your evening.